Welcome and thank you all for joining us for this episode of the Crexi Podcast, an insider's look at all things commercial real estate. In this show, we cover a broad range of topics that both cater to commercial real estate newcomers and industry leaders alike. I'm your host, Yannis Papadakis, Business Development Manager here at Crexi, a comprehensive digital commercial real estate platform designed to empower commercial real estate professionals with the tools they need to discover and transact property. Today, we are thrilled to discuss the current landscape of commercial property lending with Amber Sefert of Trimont Real Estate Advisors. Amber Sefert serves as Managing Director, Credit and Asset Management for Trimont Real Estate Advisors. Based in Dallas, she oversees performing and non-performing asset management teams. Combined, her teams manage approximately $4 billion worth of unpaid principal balance. Throughout her career, she has managed distressed and performing portfolios for various servicers. She has restructured defaulted debt, worked on receiver appointments, completed foreclosures, DILs, confirmed bankruptcy plans, and managed sold REO assets. In addition to the above, she has overseen large mezzanine positions, underwritten new debt for senior housing, and serviced performing debt. Ms. Sefert has worked in various asset management positions for the past 15 years. Before joining Trimont, she worked for C3 Asset Management and J.E. Robert Company in their special servicing departments. While there, she resolved $380 million in defaulted CMBS loans through various exit strategies. She's underwritten more than $800 million in healthcare senior living mortgages for Prudential Mortgage Capital Company. She also worked for Prudential Asset Management, servicing a $650 million performing debt portfolio. Before Prudential, she worked for Washington Mutual as a financial analyst. Amber, welcome to the podcast.
Thank you. It's like exhausting listening to everything I've done.
Well, you did it, right? That's a career's worth of
It was over
bio.
many years.
Let's dive right in and let's start at the beginning. What first got you into the world of finance and kind of led you to where you are today, leading Trimont's credit and asset management team?
Gosh, that's a good question. I would say, I think even since I was like a small child, I always sort of knew I was going to go into business. And I did a little stint in like marketing, material control, and logistics just out of college. And then it was actually more when I went back to graduate school, I kind of got more interested in real estate and finance.
Mm-hmm.
And I think just real estate is an asset class because it's tangible. There's like a story to tell. The financials kind of like help you tell the story. I just think it resonated with me more than some other parts of some other financial investment opportunities. And so I just really looked for real estate analyst positions when I got out of school.
Interesting.
And I landed at Washington Mutual, a now defunct bank, but it was a good learning experience.
Now, can you explain what Trimont is and the organization's role in the world of commercial real estate for those who aren't aware?
Sure, absolutely. So Trimont Real Estate Advisors is a third-party investment advisory, asset management, and credit oversight company. We support our clients in all of their asset management, underwriting, and servicing needs. And our clients are typically large equity groups, banks, financial institutions that are out there originating debt and equity investments. And they possibly don't have, the staffing or the department to handle the day-to-day asset management and servicing. And so that they obviously can leverage us and our expertise by engaging us to handle that portion of the business for them.
Interesting. Now, you've had a very healthy and diverse career up until today. What were some of the early lessons that you took away from in your career that you feel still serve you?
Early lessons. I would say asking a lot of questions Like that was probably an early lesson. I would also say like double and triple checking your details before you send something in to be reviewed. There's obviously nothing worse than you know turning something in, having your manager look at it, and for there to be an error on it. Refreshing grammar, like there's a lot. I was surprised by how much written work is involved in asset management. So I've definitely had to refresh my memory on commas and semicolons.
Do you also, I know I get stricken with send anxiety when I've typed out like a super important email and I read it like 5 times, 6 times, 7 times, and I'm just like, "Ah, do I send it now? There's something, I know there's something wrong with it. I just can't find out what it is yet."
No, sending an email can be like scary and intimidating. I agree. I if I have something that feels big to me to send out, sometimes I'll draft it and leave it in the drafts for like a couple hours and like go back to it. I also try, and I don't know that it always works or is conveyed correctly, but like I try to think about context and, like maybe emotion that you could be conveying. And so sometimes if I feel like there might be a little bit of like frustration or snark in the email, I definitely try to go back through and revise it. Like I'm hoping it's more matter of fact and, not irritated. But yeah, emails can be tricky. I think that's definitely something somebody should pay attention to. And I also think not everything can be handled in an email. Like email is not always the best way to manage nuance, and neither is like IM or Teams. Like sometimes I think a phone call is possibly the best way to sort of hash things out.
Oh, I 100% agree. You lose a lot of nuance and context and tone when something is in text that you can convey by just picking up the phone and talking. Hard sometimes to get a hold of commercial real estate professionals on the phone though, because they're either already on the phone or they're out in the field. I understand those pains. So
That's a fair point. Email does become the best means of communication. Sometimes we are hard to get a hold of on the phone.
it's they got it right. It's somewhere in the queue with an email. I don't think I'm like very confident that most people don't even listen to voicemails anymore. I still leave them, naively, I feel like, but it's super hard to get calls back on voicemails. Whereas, at least in commercial real estate with an email, I know they've seen it and oftentimes you get a response. Now, let's jump forward and let's walk through what happened in commercial real estate financing sector, through the pandemic, starting at the beginning. What was it like for you and your team in the early days and throughout?
I think in the early days, it felt like a waterfall was about to come. Like, there was a lot of, like, I think much like the rest of the world, there was a lot of confusion. We didn't really know what was going to happen. There's a lot of what I would call unknown unknowns. We didn't know, how long things were going to shut down, how long retailers would need to be closed, how things, like how, when, and why, like how, when, and timeline things would sort of come back to normal. So there was a lot of uncertainty, and it was very confusing. We had a lot of people who started reaching out really early saying, hey, we can't make our mortgage payment. And, on some of them, they had very valid reasons. They were hotels. They were legitimately closed down. No income was coming in. But some of them were office buildings. And we were like, why? Like, why can't you make your payment? Like, did your leases all, expire? Like, it still seems like the rental payments should be made. And it was wild. It was definitely overwhelming. I'm sure it was the same for everyone, though. I'm sure it felt that way to a lot of people.
I have had a chance to talk with a couple of other people within the industry as to kind of what their game plan was when the pandemic kind of first started, becoming real and something to deal with, from an owner side. And it seems like a lot of the people that did, I won't say well, but the people that didn't do very poorly were very proactive about conversations with either their tenants or with their
Hmm.
borrowers, and really just trying to get ahead of where the problems might be, and understanding, okay, how can we help? How can we help you navigate this? Oftentimes even directing their tenants to the different government programs for assistance throughout the pandemic. Did you find that kind of proactive conversation with borrowers was a value to you, and do you think it strengthened some of the relationships that you have with your borrowers?
Absolutely. And 100%, things were very overwhelming in the beginning, like very early days, April. And then I think very quickly we saw a lot of people who were trying to have very thoughtful conversations. So a lot of our borrowers, were doing amendments to their leases. So, for example, if retailers were closed down, they were trying to estimate, is 2 to 3 months of rent deferment enough to help them get back on their feet. So we saw a lot of lease approvals kind of to modify large leases. We also looked at a lot of interest payment deferrals to help a lot of our borrowers kind of get through the heavy shutdown periods. We saw a lot of groups making a lot of interesting requests, and we were actually able to come to terms and approve quite a few of these. And we got very flexible about using reserve funds to help support interest payments. We got flexible at kind of waiving our interest floors, which meant that, since LIBOR was so low in a lot of our floating rate debt, borrowers were paying a slightly lower payment. We got very comfortable not needing to capture replacement reserves, which helped make the monthly payment a little more manageable. We got very flexible at extending debt out. I think in a lot of instances, we were able to work very closely with borrowers and help them structure a plan that helps keep their loan current, and also gave them a little bit of flexibility to get through the really heavy months of the pandemic. And I
Hmm.
think in return, a lot of our borrowers were able to offer that same type of flexibility and consideration to a lot of their tenants. On the multifamily side, I definitely think the government assistance helped a lot of people make their rental payments. I think overall we saw much less delinquency in that product type than we maybe thought we would have seen very early on. And we're aware that a number of our property owners were able to receive PPP funds. We were thoughtful about kind of acknowledging the receipt of those funds in any kind of legal document or modification we had drafted. And I think those funds helped to keep some of these businesses moving forward. And hopefully, similar to, well, all of the states actually, they had various stages and time periods for shutdown. And then I think a lot of retailers and restaurants and other places were able to open up at some type of capacity, whether it was like 25% or 50%. And obviously that was a huge struggle for a lot of them. And I know a large number of places weren't able to make it. But I think, the slowly reopening and then the rent forgiveness or deferment helped some to survive through the unprecedented time that was last year.
Absolutely. And I mean, it was unprecedented. And, in that vein, in what ways would you say this downturn was different from the great financial crisis?
Yeah, I mean, there's a lot of ways. I feel like in 2008 and 2009, there wasn't as much liquidity. You couldn't as easily get additional debt. And so we worked a lot to extend, assume, restructure the debt that we had in place, because on defaulted loans in the CMBS securitizations, we had that flexibility. And this go round, for groups that were comfortable, like debt was still available, liquidity was still around. So it definitely felt a little different. Everyone was kind of on a pause, and obviously, everyone's looking to underwrite your operating statement. So everyone's operating statements looked a little different. There was definitely some struggle for a number of months in there, and I think now that some time has passed, I think we're seeing, the extensions, the modifications that we made have played out, and the debt forbearance, the deferment, and the extensions have played out to help borrowers bridge that period of time just to get to the point where they needed to refinance. I also think the way the federal government and all governments participated in this downturn, it was obviously I'm going to say a health pandemic, or a pandemic, and not as much of a financial crisis that triggered it. Made things very different. The unemployment and the stimulus checks was very different than last time, and the PPP funds. There was more. The government participated to support in a different way during this pandemic than they did during the Great Financial Recession.
Right. And, as we near the other side of COVID, what are relationships between tenant, landlord, servicer like today, right? Following up on those conversations of forbearance, foreclosures, evictions, now that the moratoriums are wrapping up, what will likely happen?
I'm going to say for the most part, they're pretty amicable, and they're very matter of fact. And as I'm saying, for the forbearances and modifications where we've seen the forward projections play out, like where we see the economies open back up, where we see travel starting to come back, where we see the property's operating performance is starting to improve, they're amicable just as they were previously. I'm going to say a smaller number, there's probably still some thought around, do they need a little more time? Are they, unique and in a state that maybe is very densely populated and opened up a little later than some other places in the U.S.? It's possible. And I mean, I don't know that we're completely through all of the restructurings, but I think they've definitely shrunk and they're much smaller number. And then I'm sure we'll have, a very small number that the business plan we were projecting when we tried to modify them isn't actually going to pan out. And we may see some defaults, but I do think overall we've seen a lot less defaults than we sort of anticipated at the beginning of last April.
Nice. Well, looking ahead, I think the big question is, what does the path to economic recovery look like, and how far off is it? Are we starting to, get back into the swing of things? It certainly feels that way talking to brokers and watching, transaction velocity in the marketplace right now. What are you seeing on your end?
We're seeing clients get very busy. Like, we've seen the groups that are ready to go out and originate new deals. We've seen them come back at a very fast pace, which I think is good. We're seeing a lot of activity, and I would say I sit in Dallas, and we've been fortunate that we have a lot of space here, so we've been open for a while. I mean, things definitely feel busy. I've been to the airport. The airports look busy. I was in Iowa last weekend and had a really hard time getting a rental car, which was a new experience. But it feels like the economy's coming back. And having said that, it feels busy right now. But I don't know that all of the retailers and bar and restaurant establishments have been able to staff up enough to fully reopen. I do still think we see some places where the hours aren't as long as they used to be, and maybe they're still trying to get their feet back under them to fully reopen after last year. But it definitely feels busy. How does it feel where you are?
Ooh, I think people are very excited to get back out and on with their lives. I think especially in a place like Los Angeles where, what you can go and do is such a big part of living here, right? If you're going to be locked inside, right, for a year, I mean, you could be locked inside for a year anywhere. You don't necessarily need to be in LA to be locked inside for a year. So having, starting to get, life back outside of your own apartment is definitely something that people are excited about. The handful of bars in my neighborhood that have been open with, outdoor, like alfresco seating, have been absolutely packed from the moment they could open. And I expect there'll be more of that. What I am seeing is it does seem like a lot of places are understaffed. And then the staff that they are bringing on now isn't necessarily the same staff that they had pre-pandemic. So, maybe they had, skilled workers that, had been there for a while and, understood, the kitchen flow or the bar flow, and, things kind of moved like clockwork. Now they're up against not only being understaffed, but also it's usually a newer staff that, is just learning it this first time around. So there's definitely some kinks, but it does feel like it's really moving in the right direction.
Is it harder? I mean, I feel like it's always hard to get a reservation in LA. Like, is it getting harder even to get a reservation? Because even as someone in Dallas, where it's relatively easy to get one, it's been harder recently. Like, it feels like everyone's back out at the same time, and it feels crowded.
Absolutely, and not even the places that require a reservation. Over the weekend, actually, I was driving around with my sister running errands on a Saturday, and we were just looking for a place to stop and grab a bite real quick. And there's this great New Orleans Cajun spot in Chinatown called Little Jewel of New Orleans. If you're ever in Chinatown in LA, they've got an excellent po' boy there. But there was a line wrapped around the block because they were still conducting business through a little order window because people can't walk in to the store the way they have it set up right now. I cheated though, and I placed a takeout order through my phone and basically skipped all the live bodies in the line and ended up getting it before I had to wait to get to the front of the line. So there are still some advantages to using some of the, the COVID forced tech that, these companies had to use to adapt and stay open. So if you see a huge line, check and see if you can order it through your phone ahead of time, because maybe you don't have to wait in the line.
Free tip. You got it here first.
Sorry to everybody I cut at Little Jewel. Now let's see what's, and this is kind of, on the other side of the spectrum here, kind of delving into a little bit more negative territory. What signs of distress are you currently seeing? What's happening out there that concerns you, if anything, and to what extent? Is there, does that distress, translate to new opportunity?
So let's be honest, there's always some distress. Like, there's, always some situation where, I don't know, maybe you have not the most invested borrower or a property manager who let something slide, or, there's a huge new development and your, operations slow down. There's always some distress in the market, which I don't think is a surprise to anyone. So we still have some. We had some before COVID. We've, gotten a couple more deals through COVID, and I'm sure we'll get some more. I feel like for the properties where we still had a very invested property owner, an invested borrower, and they had the wherewithal to continue to support the property financially, it really feels like we've been able to work through some type of a plan with them. And then, in some instances, there are, I'm going to say, specific reasons why it doesn't make sense for them to continue to contribute to the property. And in those instances, we look to the other tools we have in our toolbox, which can be having a receiver appointed to the property, or it can be foreclosing on the property, operating it as REO, and selling it, or it can be looking at placing either the debt or the REO in a loan or REO sale platform and auction it off. And I think, we've had very good success at doing all of those things using all of those tools as exit strategies.
I know that actually very well, as I'm currently working on Crexi's auction platform, and We have seen an uptick in demand for, not only institutional players, but also private clients that are looking to auction to help, you know, get out of a deal and move their equity to something else, to liquidate and move on. It's been extremely successful. I expect we'll probably see more of that moving forward. Do you think that, for certain asset types, right, there is, things that really hinge on kind of, what the economy is doing, for retail, right? It's really based on people's willingness to go shopping, in terms of actual brick and mortar retail. With offices, everybody has had a year of working from home, and there'll likely be some, hybrid, moving forward of, work from home as well as in office space that may require smaller space. How do you, um, read the tea leaves, so to speak, in knowing how do we change our underwriting to keep up with, this new world that we're in post COVID?
That's a good question. Um, I think, I mean, I'm sure everyone reads the news articles, but retail sales in brick and mortar stores are, still down. I think there is a much stronger appetite to buy and have things shipped to you online. I will say that, having to process your own returns at your house can get exhausting. And, I do still think there's actually benefit to having brick and mortar storefronts. I do think, the smaller footprints and a lot of the changes that the retail sector is seeing right now are probably appropriate. And then office is definitely a variable. I think a lot of people through the last year have proven they can work from home and do just as effective of a job, complete all of their work at home just as they could in the office. But I do still think there's value in collaborating with your coworkers. So I think office is going to be a mix. Like, I actually think some companies are going to support the continued need and use of office space. I think it might get a little more flexible. I think maybe you're going to see 1, 2, 3 days of work from home flexibility a week. But I don't think office takes I don't think using office space disappears in a large way. I think maybe it adjusts. I do think there are probably some companies that will decide they don't need the space that they have. And I think we probably will see some transition in office, but their leases are longer. So if we see that all immediately, or, maybe it kind of like slowly trickles and adjusts as their leases expire over the next, 2 to 7 years, maybe we see a blip or a bubble. I don't know that we're going to see anything dramatic. That's my opinion.
Well, are there any patterns that are emerging that you are seeing in terms of, transactions, loan origination in certain markets versus others?
I think we've seen a healthy appetite for hotels, which is good and exciting. I think a lot of this is probably going to be based on our clients' preferences, because, they're in a lot of instances out there sort of with our guidance deciding on which deals make sense for them and quoting on them. But we typically see very heavy and larger MSAs and I'm going to say traditional asset classes. But I think just seeing a lot of comfort with hotels has been one of the trends we've seen.
Right. Now, given potential tax reform from the Biden administration, what impact do you see that having on your team's clients and their portfolios?
I don't know. I mean, I definitely think it's going to affect their decisions, but how and, if all of this actually gets through Congress is yet to be seen.
I mean, just from where I'm sitting on the transaction side, working with auctions, I am noticing more brokers that are bringing us, auction inventory, telling us that their client's reason for selling is they want to get ahead of any increased capital gains that may be coming through the pipe. And so maybe people that, had a 5-year plan, becomes a 3-year or 2-year plan now, and they want to, make those moves now. Are you seeing or hearing anything similar on your side?
I mean, we're definitely seeing a healthy amount of payoff activity, and I guess it's hard to know since, on the flip side, we agreed to so many extensions last year. If it's, we definitely have some debt that's maturing and, the payoffs are naturally coming. It's possible that some of the borrowers are also interested in just kind of exiting their real estate holding based on potential tax changes also. It's possible that, all of those concepts are floating around and helping to support their decision. But I don't know that we've seen an abnormally high number, and we probably expected to have a higher number of payoffs this year just because, we had extended things to help everyone get through the pandemic. And hopefully now they've got enough strength under their operating activity that they're actually in a position to go out and get new debt.
Awesome. Well, we've gotten to the end of our talk track. Do you have any parting words of advice to share with, commercial real estate investors managing their portfolios today?
That's a really hard question. I would say keep it up. We're happy for everyone to continue to be out there making new loans. We're happy to help support them do that.
And any advice
Do you have some good advice?
Oh man, I wish. That's why.
You're pinging people.
If I did have any advice, it would be, if there's something specific that you do within commercial real estate, if you specialize in it, just make sure that you're focusing on, what you do best, right? And if times change, then you need to change your approach. That's fine. Become an expert at whatever the new approach is. But kind of stick to your guns and kind of double down on what's working for you. That's nobody comes here for my advice, though. They want your advice.
Yeah. I would say stay active, and then remember if you need to make a change that you have a lot of tools to choose from. You can sell your property, market it on a platform, refinance it. You have lots of options. I don't know. I don't really have much advice right now. This is maybe yeah, I don't have a lot of advice. Sorry.
You know what? I did hear something good from a previous guest, and that is, there's opportunities in every market, right?
Good. That's good advice. Let's steal it.
No matter what happens, there's always opportunities, right? So just hanging up your hat and saying, well, everything's gone to hell. What's the point? There's people that were still grinding all of last year that had spectacular Q4s because they refused to slow down. They said, okay, things are changing, but it doesn't mean things are stopping, right? There's got to be something in here for me to get my hands dirty with. And I think a lot of people really did reap the benefits of that towards the end of last year.
I like that advice. Let's take it. There's opportunities in every market. Let's make that our advice.
All right. I'm sticking to it. Well,
yeah.
Thank you so much for joining us and for sharing your insights, especially on such an important and timely topic. We really appreciate your time today. And I know you're very busy, so thank you for taking the morning to sit down with us.
Thank you very much for having me. I enjoyed it.
Now, where can people find you online if they want to get in touch? Email, social media?
I feel like I have a LinkedIn profile, but I don't even know that it's updated. I don't know that I'm really Googleable.
That's nice. I'm a little jealous, if let's say somebody wanted to get in touch or, have questions for you directly, or maybe they want to engage Trimont, is there a portal to do that? How would you recommend?
Our website. Yes, I would say please check our website. Our contact information is out there, and we would be very interested in having someone from our client services team speak with you.
Fantastic. Well, thank you, and thanks to everyone who tuned in today. If you enjoyed this episode, do not miss the next one. Visit go.crexi.com/podcast and sign up to get the next episode delivered straight to your inbox. Of course, you can also subscribe to the Crexi Podcast on your favorite podcast app and check out our YouTube channel for video recordings of each episode. Take care and be sure to tune in next time.